Hi, welcome to another one of the macro hedged options course videos. This one is all about short sterling, UK sters, equivalent of euro dollars, but obviously in sterling. And the topic: will UK rates go negative? Let's take a look. So this trade for me, you can spend an eternity assessing whether or not the Bank of England will actually activate and lower rates to a negative base rate. There's a lot of people positioning for it. There's a and it can pay off quite considerably. But what we're going to do in this video is look at how can we structure something that's really cheap. So if it is a long shot, we're not going to be spending a lot of money on it. But also, if it does happen, it pays off because it's not an event that's going to repeat itself. We thought that about Europe, but it's not an event that's going to repeat itself, or it's probably not an event that's going to accelerate. So when if you have the Fed on a rate hiking cycle, it tends to build up to an end of cycle and then come back down. This might be similar to what's happened in Europe. Is that it becomes, whilst it becomes an arbitrary beneficiary policy, it doesn't move that much. So this is our chance. Let's take a look and see if there's anything out there that we can structure for. So here I've just got the out the money volatility. This will be in basis points, so it's not percentage obviously because it hardly moves, but so that it'll be Bachelier model. And we can just see that vol's just coming off. There's a between the September and the December I've got here, and vol's just leveled out as the price of the futures just risen considerably all the way up to where it is now, where it's kind of representing current base rates. So let's have a look and see if we can structure something. Vol curve seems to be kind of steepening as further we go out, but for me in this, there's a lot of people playing this kind of as early as July and August, and obviously then kind of getting themselves in on this September play. I want to look for something further out. I'd like a little bit more time. I think this is just a personal preference, and I'll structure something that works off my preferences. I think it won't happen as quickly as people want it to happen. So I want to be in something for a little bit longer, but we'll price up both and see where the differences are. A quick look at the futures price here before we do. Just long-term range here is just completely flat, sitting around that 0.5% mark where it seems to have been for an eternity. And obviously since COVID's broken out, the rise up now towards 0.1 or 0.25%, and obviously all the chat about us moving into these negative rates. And then obviously we've got the spike in realized volatility, as this is a 20-day lag, hence the spike here, and then the rise in vol, and then obviously that's just fallen away as we've neared 100. Okay, let's get a price up. With any of these type of rate guess plays, you're trying to capture the zone. What I mean by that is, so if price is here, they're going to move rates to this block. You're never. They may always trade at a discount, but you want to kind of be in this zone here. You don't want to overspill so that they've cut rates too much into negative territory and you miss it. So, whereas if we look here at this particular call fly, this is in the U currently, we're right here at the moment, and this is 99.87.5, 100, 125. So you can see, if they are likely to cut, what would it go to? Maybe kind of negative 0.1%, so maybe here. So what would your profitability kind of sit at this point? Yes, you'd be in the money, you'd make a couple of ticks, but if they surprise and go hard heavy and do move from their current stance to negative 25 basis points, you've given up. You've just seen this kind of flow over the top. You've gone right over the bridge. So whilst it's cheap, this particular strategy I'm looking at here, it's super cheap. The strategy is $16 per one lot max risk. So, we're really not looking here at much cost at all, but then we need to make sure we maximize. Something that's worth doing is maybe considering adding another strike here. And making it a condor. oops, let's just, sorry about that. So certainly now, I mean, whilst the costs increased to 2 ticks, our opportunity has certainly has gone up here. Is if they did cut to the if they did just cut kind of 0.1%, it's a fairly chunky risk reward of 4x. And if they did go for 25 basis points into the negative, you've still got some profit sitting as we sit around here at this line. But timing on this particular trade is it's 116 days from now. Let's have a look and see what happens if we price up something into the December. So interestingly, if we price to a December, it doesn't change a single thing on the price. So if we just move this, you can see here, if I move that, the days has changed for 116, and the actual price difference, all that's happened is nothing has changed for the premium paid, which is just giving you an extra 100 days for zero risk. And also your risk return here is also greater. If we do fit into that bubble of just cutting 0.1, you're obviously you've hit the jackpot, being 4R your investment. But even around this 0.25, there's a decent risk return of 2 to 1. But you can just see this is a very being deemed in the market as quite a short term outcome. So that you can double the time you've got for this to play out for zero cost. Now, something else you could do is you could move the whole thing up a strike. So instead of the 99, 87.5, you're going 100, 100, 12.5, 25, 37.5, which cuts the price in half. And again, if we're looking at that, you've moved that sweet spot of the negative zone from right over where you want it to be. If we're thinking it's going to be 10 basis points to 25 to negative 25, you're right here. So whilst it's cost you a tick, if we do end up kind of settling off in that zone, you're up there at kind of a truly 8, 9, 10 R. So that's, if I was going to be looking at anything, if this, we've still got to obviously take into account that we may be trading, the Sturs might trade at a bit of a discount to actual BOE rates, like we're seeing in the euro dollars against the Fed funds. But we're certainly this trade to me, looks the best play, is where we've got something that's giving us 207 days to play out. It's costing a tick, so it's $12 a lot, £10. You've got the rest of the year for it to play out, and if it does come good, this trade will pay 8, 9, 10 R. I mean, the maximum you can get is 10.5 R from your investment if we sat there, but it's in the sweet spot of where you want to be. And if you're wrong, it's cost you a tick. And even what I would look at is we might, you might even see a little bit of pressure in the futures moving towards, as everyone kind of starts to get more and more fearful of the BOE doing it, especially if they come out dovish in the next couple of meetings, of just moving into this zone anyway, which will double your money. You can get out of half your position. And then it's just still a profitable runner anyway. So that's how I would do it. Just I give myself more time, and the cost differential looks to be kind of favourable for that as well. All right, cool. Good luck. Cheers.